Have you ever paused to think about why a bottle of milk costs what it does? Or what exactly a $1 trillion deficit actually means for your pocketbook, for the future?
Yeah, the numbers can feel so abstract, can't they? Almost like they belong to a different universe entirely.
Exactly. But their ripples, they really touch everything in our daily lives, often in ways that aren't immediately obvious.
Mm-hmm.
So today, we're going to dive deep into those hidden currents. Welcome to the Deep Dive. I'm your host. And today we're embarking on a journey through, well, quite a stack of fascinating sources.
We've got detailed government reports, some cutting-edge academic research, analyses from central banks.
Right. And our mission here is to transform these, let's face it, often complex financial and economic concepts into clear, actionable understanding for you, our listener.
So you can feel truly well-informed.
Exactly.
And we're not just going to skim the surface today. We're really putting on our Feynman technique hats.
Ah, the Feynman technique, breaking things down.
Precisely. That means we'll explain each concept simply, first off. Then we'll identify areas where we, or maybe you, might still have questions. Our knowledge gaps, as we call them.
Okay.
From there, we simplify even the trickiest bits. We'll try to connect everything with concrete analogies, make it relatable,
Good.
and tie it all together. The goal is to give you those genuine aha moments, without the usual information overload.
And maybe spark some new questions, too.
Hopefully, spark your next area of curiosity about how this whole system works.
The accumulating bills, demystifying government debt and deficits.
Okay, let's unpack this first one then. We constantly hear terms like national debt and budget deficit thrown around in the news.
All the time.
Often as if they're interchangeable. But there's a crucial difference, isn't there? Understanding that seems key.
Absolutely key.
And maybe more importantly, why should we, as individuals trying to manage our own budgets, really care about these huge sums? They seem so far removed.
That's a fair question. It often sounds like something just for economists or politicians to worry about.
Right.
But you've hit on a critical point. While the terms are related, they describe different financial realities. Think of it this way. A budget deficit is, it's like a snapshot.
Okay.
A snapshot of a household's finances for just 1 month, or maybe 1 year. It shows they spent more money than they earned in that specific period.
So just for that year.
Exactly. A deficit for that year. The national debt, on the other hand, that's the grand total, the accumulation of all those past deficits stretched over decades.
Ah, okay.
It's essentially the country's outstanding credit card balance, if you like, the total amount owed from all past borrowing.
Got it. So every time the government spends more than it takes in taxes and stuff, that annual deficit gets added onto the big pile, the debt.
Precisely. It just keeps growing the total balance.
Yeah. So if the deficit is the monthly overspend, the debt is that ever-growing total tab. And these aren't just abstract numbers floating around, are they? What are the CBO's latest projections telling us? Where is the U.S. heading with this debt? It feels like the numbers are getting, well, huge.
They are. And the trajectory is, frankly, quite alarming. The Congressional Budget Office, the CBO, they provide independent budget analysis. They project U.S. federal debt held by the public will climb to a staggering 156% of gross domestic product, or GDP, by 2055.
156%.
Yes. 156% of the entire size of the U.S. economy.
Wow. How does that compare historically?
Well, to put that in perspective, it would significantly exceed the historical peak. That was 106% of GDP, reached right after World War II.
After a world war.
Exactly. A time when the nation mobilized its entire economy for global conflict. But what's maybe even more striking and concerning is the CBO projects were set to pass that post-WWII peak much, much sooner.
How soon?
By 2029.
2029. That's just around the corner.
It really is.
Yeah.
We're talking about a future that's not distant at all, but rapidly approaching, where the national debt relative to our economy will be at an all-time high in peacetime.
That's a monumental jump, even from wartime levels. And this isn't just a future problem, is it? The immediate figures show this acceleration, too. What's the Treasury Department saying about this current fiscal year?
The immediate data absolutely reinforces those long-term projections. Recent figures from the Treasury show the U.S. budget deficit already surpassed the $1 trillion mark.
Already?
By February 2025 for this current fiscal year.
February, that's incredibly early in the fiscal year.
It's the earliest this milestone has ever been reached and signals a really rapid rate of accumulation. Just for February alone, the deficit was $307 billion.
Just 1 month.
Just 1 month. And this rapid early accumulation, it isn't just some random blip. It really indicates that the fundamental dynamics, the balance between government spending and revenue collection are, well, deeply out of whack.
We're consistently spending way more than we're bringing in.
Year after year.
Yeah. So what are the biggest things driving this spending surge? Especially looking long term. Is it like big new government programs or something more baked into the system?
It's largely structural, driven by commitments already embedded in our system. A significant chunk of this long-term spending growth comes from what we call mandatory programs.
Mandatory meaning?
Meaning the spending happens automatically based on eligibility rules, not annual votes in Congress. Think vital social safety nets, healthcare initiatives, Medicare, Medicaid, the Children's Health Insurance Program, CHIP,
And Social Security.
and of course Social Security. These programs together are projected to increase from about 5.8% of GDP in 2025 to a much larger 8.1% in 2055.
That's a big jump.
It is. And within that group, Medicare is the main driver. It's projected to reach 5.2% of GDP all by itself in 2055.
Why Medicare specifically?
Well, it's not surprising given our aging population, right? And the relentless rise in healthcare costs. You got technological advancements, new expensive treatments, and just increasing demand for services from a larger elderly demographic living longer.
So the promises we've made for retirement and healthcare are getting more expensive.
Exactly. As our population ages and lives longer, those costs naturally rise.
Sounds like a demographic time bomb meeting a fiscal challenge. Okay, but what about the other side? Revenues, taxes. Are they keeping pace at all, or are they falling behind too?
Unfortunately, revenues, while they are projected to rise somewhat, they just won't keep pace with this accelerated spending.
So the gap widens.
The gap widens. The main sources of government income, individual income taxes, payroll taxes, they're expected to increase, but just not enough.
Yeah.
And what's particularly interesting, maybe a point of concern, is that corporate income tax receipts,
Yeah.
they're actually expected to decline relative to GDP over the next decade.
Decline. Why is that?
Several factors, probably. Globalization means profits can move around more easily. There's increased tax competition between countries, shifts in corporate structures, accounting practices. It all allows for more, let's say, efficient tax planning.
So less corporate tax coming in relative to the economy size?
Right. Which means that widening gap between spending and revenue just keeps growing, pushing the need to borrow and therefore the national debt even higher.
This really does sound like a family budget spiraling out of control. Let's try that analogy to make it hit home. Imagine your family, right? Year after year, you consistently buy just a bit more than you earn. And you add it all to this huge, ever-expanding running tab at the local store. That tab keeps growing. And with it, the minimum payments you have to make just to keep the account open.
Right, the interest.
Exactly. Eventually, those minimum payments become so big that they start eating into what you need for essentials. Things like healthcare for the kids, education funds, even just basic groceries.
It limits your choices?
Dramatically. It's not just about what you can't buy anymore. It's about what you must pay first, leaving less and less for everything else that actually improves your life. That's basically what's happening nationally, isn't it?
That analogy perfectly captures the core issue and its very real implications. The CBO is clear about several severe consequences of such large and growing debt. First, and this is crucial, it can lead to slower economic growth.
How does that work?
Well, when the government borrows heavily to cover its deficits, it's essentially competing with private businesses for available capital, for savings.
Ah, okay. Soaking up the money.
Exactly. It's often called crowding out. There's less money available for private companies to invest in new factories or innovative R&D or creating new jobs.
And less private investment means?
Less private investment translates directly into lower productivity growth, fewer good-paying jobs, and ultimately a slower overall expansion of the economy. It means future generations inherit a less dynamic, less prosperous economic landscape. Second consequence, higher interest payments. Just like your family's store tab, as that national credit card balance grows, the cost of servicing it grows too.
Paying the interest.
Paying the interest. A larger and larger slice of the federal budget has to go towards just paying interest on the debt. The Treasury reported nearly $396 billion paid so far this fiscal year just on net interest.
$396 billion just on interest.
Just interest. That money isn't funding schools or fixing roads or researching cures. It's simply paying for past borrowing. And often, a significant chunk of these payments goes to foreign lenders.
So the money leaves the country.
Right. Instead of being reinvested domestically, it's a tangible loss of potential investment in our own future.
Mm.
Third, restricted policy choices. Imagine facing a new crisis, another pandemic, a major recession, a national security threat,
Yeah.
but finding your hands are tied because so much of the budget is already locked up, paying debt interest. Lawmakers might find they have fewer options to respond effectively, fewer resources to fund critical new initiatives that could really benefit the country.
It limits your ability to react, to invest.
Exactly.
Yeah.
Limits the country's agility, its capacity to shape its future. And finally, there's an increased risk of a fiscal crisis. Now, financial markets seem relatively calm right now, but the CBO explicitly warns that mounting debt could eventually erode investor confidence.
Confidence in the U.S. government's ability to manage its finances.
Precisely. If that confidence falters, it could trigger a sudden, sharp increase in the interest rates the U.S. has to pay on its debt, making borrowing even more expensive.
A vicious cycle.
Potentially. It could also lead to a rapid drop in the dollar's value or trigger higher inflation expectations, all of which would make the problem much worse, much faster. It could spiral.
So it's a risk that might seem remote now, but it could change quickly.
The CBO emphasizes it could change suddenly due to unexpected events. It's a tail risk, but a significant one. Now, this brings up an important question, a knowledge gap for you to consider. We know the CBO projects the U.S. population might start shrinking by 2033 without immigration. Fewer workers supporting more retirees. How might that profound demographic shift specifically alter the long-term sustainability of programs like Social Security and Medicare?
Yeah, that's a huge question.
And beyond the usual talk of budget cuts, what truly innovative, maybe non-traditional solutions might emerge? Could technology play a role? New social structures? How could we address these funding shortfalls without just digging the debt hole deeper? Something to really think about.
Okay, so our national credit card bill is growing, the interest payments are rising, and the risks are mounting. Not just for our domestic economy, but maybe for our global standing too. How does this huge debt affect something as fundamental as the US dollar's role in the world? And what about these whispers of de-dollarization? Are they serious? Let's shift focus to the greenback itself.
The greenback's global reign dominance, diplomacy, and de-dollarization.
The US dollar, it's often called king in global finance, right? And for good reason. Most of us get that it's widely accepted. You can use it almost anywhere. But what does being the world's principal reserve currency actually mean for the global economy? And what kind of power does that really give the United States? It seems like it's more than just convenient for travelers.
Oh, it's far more than just convenience. You're right. In simple terms, a reserve currency is like the world's default money. Sure. The sort of benchmark currency for international transactions and global savings.
The go-to currency.
Exactly. It's the currency that central banks all around the world hold in large quantities as a big part of their foreign exchange reserves, like a global savings account for countries.
Okay.
And crucially, it's the main currency used for international trade, especially when countries are buying and selling major commodities on the global market.
Like oil.
Like oil, definitely. Think of it as the most trusted, most liquid, and generally most stable currency for conducting business across borders, settling international debts, and storing value long-term. Now, the dollar has held this incredibly powerful position, according to the Council on Foreign Relations, CFR, pretty much since the end of World War II.
Right.
The Bretton Woods era set it up.
Right.
This long history of dominance has made it the most used currency for international trade by a really significant margin. And a key factor in its enduring strength, giving it unique leverage, is the petrodollar system.
The petrodollar, meaning oil is priced in dollars.
Primarily, yes. Major commodities, especially oil, are mostly bought and sold using U.S. dollars. So even if, say, Japan is buying oil from Saudi Arabia, they typically need to get dollars first to make the transaction.
So everyone needs dollars, even if they're not trading with the U.S. directly.
Precisely. And many countries, like Saudi Arabia itself, even peg their own currencies directly to the dollar. They fix their exchange rate to it. That further solidifies the dollar's role as the anchor of the global financial system.
So it's not just the size of the U.S. economy, it's how the dollar is woven into global trade, especially for essential things like energy. What are the core reasons for this strength? Why has it lasted so long?
The CFR points to several key pillars. First, its perceived stable value. Historically, the dollar's been seen as a reliable place to park money, especially when things get shaky globally.
A safe haven.
A safe haven, exactly. Second, the sheer size and openness of the U.S. economy. It provides unmatched depth and liquidity for financial transactions. Trillions flow through it daily.
Okay.
Third, and you can't underestimate this, is the country's significant geopolitical influence and its strong rule of law. People trust that contracts will be enforced, that property rights are secure. That builds confidence in its financial system. But perhaps the most unique factor, and often overlooked, is the market for U.S. government debt, U.S. Treasuries. No other country in the world has a market for its government bonds that comes close in terms of size, liquidity, and perceived safety.
How big is that market?
It totals roughly $22.5 trillion.
Wow.
As CFR's Brad Setzer highlights, it's incredibly hard to compete with the dollar without a similar reserve asset. U.S. Treasuries are seen as the ultimate safe, liquid investment for central banks, big institutions, even individuals around the world. There's just no real substitute on that scale.
So the Treasury market itself is a key pillar of dollar dominance.
Absolutely. It provides the bedrock for the dollar's global role. Now, this dominance, it's powerful, but it's not without its complexities. It grants the United States what a former French finance minister famously called an exorbitant privilege.
Exorbitant privilege? What does that mean?
Well, on the plus side, this high global demand for dollars allows the U.S. government to borrow money more cheaply than it otherwise could. There's always this eager international appetite for dollar assets like treasuries.
So lower interest rates for the U.S. government.
Exactly. And it also gives the U.S. an incredibly powerful tool for diplomacy and foreign policy. Most notably, the ability to implement far-reaching economic sanctions.
Like cutting countries off from the financial system.
Precisely. Effectively isolating individuals, companies, even entire nations from using the dollar-based global financial plumbing. But, as I said, it's a double-edged sword. This strong dollar dominance can also hurt domestically, particularly export-heavy U.S. states and industries.
How so?
A strong dollar makes U.S. goods and services more expensive for foreign buyers. It acts almost like a tax on exports. This can lead to persistent trade deficits, job losses in manufacturing or agriculture, as foreign buyers find U.S. products less competitive.
So good for borrowing cheap, maybe not so good for selling things abroad.
It creates those economic imbalances at home. It's a privilege, yes, but one with domestic costs.
Okay, here's where it gets really interesting. Because while the dollar's dominance is clear, there's growing talk, growing fears even, about something called de-dollarization. What exactly is that? And is it a real, tangible threat to the dollar's reign?
De-dollarization. It's the process where countries actively try to conduct their international trade and hold their foreign reserves in currencies other than the U.S. dollar.
Trying to move away from the dollar?
Essentially, yes. And this trend has definitely gained momentum in recent years, especially after the Russian invasion of Ukraine in 2022 and the very extensive U.S. and allied sanctions that followed.
The sanctions were a wake-up call for some countries.
Absolutely. They demonstrated just how potent the dollar could be as an economic weapon. That pushed some nations, especially those with, let's say, geopolitical friction with the U.S., to actively explore alternatives.
To reduce their vulnerability.
Exactly. To reduce their vulnerability to U.S. financial leverage, achieve greater financial autonomy. They want to avoid a scenario where their reserves could be frozen or their access to global markets cut off. However, and this is a big however, despite these efforts, despite the rising rhetoric, the sources we've looked at consistently suggest that few serious, viable contenders have actually emerged to replace the dollar systemically.
No credible alternatives yet.
Not really, not on the scale needed. It makes it highly unlikely the greenback will be dethroned as the leading reserve currency anytime soon. The alternatives just lack the necessary scale, the deep liquidity, the perceived safety, and the trusted institutional frameworks that the U.S. Treasury market and the broader U.S. economy provide.
What about the euro or the Chinese renminbi?
Well, the Eurozone is large, but it lacks a unified fiscal and political structure, like a single treasury issuing debt for the whole bloc. That weakens its appeal as a single reserve asset. China's renminbi, while backed by a huge economy, isn't fully convertible. China maintains strict capital controls. That fundamentally limits the trust and liquidity needed for a true global reserve currency. You need to be able to move money in and out freely and easily. We also see some fascinating geopolitical nuances playing out. The Council on Foreign Relations notes these shifting dynamics in oil geopolitics. For instance, Saudi Arabia adopting a more non-aligned stance regarding Russia and Ukraine, trying to balance its relationships.
Playing both sides of it.
Perhaps navigating a complex world. And you see China stepping in, brokering that significant diplomatic deal between Saudi Arabia and Iran recently. That highlights this complex web of evolving international relationships, emerging power brokers.
Interesting.
Yet, despite these shifts, Despite calls from some countries for alternatives, Saudi Arabia still pegs its currency directly to the dollar.
Still tied to the dollar.
Still tied. It underscores the deep, structural, sometimes inconvenient reliance on the greenback for stability and global market access. It's a testament to just how deeply entrenched the dollar system really is.
That's a powerful picture of how embedded it is. Let's try another analogy to really solidify this idea of the dollar's global role. Think of the dollar as the universal measuring tape in a massive, bustling global marketplace.
Okay, I like that.
Everyone trusts this measuring tape for its reliability, its consistency, its accuracy when they're trading everything from spices to heavy machinery across borders. Now, some vendors, for their local deals, might prefer their own scale, their local currency. But for the big international trades, they almost always pull out that common, universally understood measuring tape, the dollar. Why? Because everyone understands it, everyone accepts it, and crucially, everyone sees it as the most reliable standard for comparing value across different goods and different countries.
That's a perfect way to illustrate it, the trusted global standard. Now, here's a knowledge gap question to push this further. Thinking about the big picture, connecting this to history. We know global reserve currencies can shift, like the British pound eventually declining after World War II.
Right, it's not unprecedented.
Exactly. So what unexpected black swan events or truly transformative technological breakthroughs, things not explicitly in our sources, maybe quantum computing breaking current encryption, or a truly decentralized global digital currency taking off, or some major geopolitical realignment. We can't foresee what could realistically accelerate or decelerate this long-term trend of de-dollarization beyond what current projections suggest.
Thinking about the real disruptors.
Exactly. Moving beyond incremental changes to systemic shifts, what could really shake things up?
Okay, the dollar's role clearly influences trade, stability, power dynamics across the globe. It touches everything. Now, let's turn our attention inward again to another powerful force that affects every single one of us every day, sometimes very painfully. Inflation.
Yes, inflation.
And the central banks that are constantly trying to keep it under control. It's a nonstop balancing act, isn't it?
The price surge puzzle? Inflation, central banks, and pricing behaviors.
Inflation. Yeah, it's the word on everyone's lips when prices at the grocery store, the gas pump, rent, they all seem to jump overnight. It eats away at our budgets. We feel it directly.
We definitely feel it.
So in simple terms first, what exactly is inflation? And what's a central bank's main job? Is it just keeping prices down? Seems more complicated than that.
It is more complicated, though we all feel it simply as rising prices. At its core, inflation is that general increase in the price level for goods and services over time. And as you said, that leads to a fall in your purchasing power. Your money just buys less. But for central banks, like the U.S. Federal Reserve or the Central Bank of the Republic of Turkey, CBRT, their primary mandate is usually achieving and maintaining price stability.
Price stability, meaning zero inflation.
Not usually zero. Typically, it means aiming for a low, predictable rate of inflation, often around 2% or maybe 3% in some cases. That's considered healthy.
Why is a little inflation healthy?
A little bit gives the economy some flexibility, encourages spending and investment rather than hoarding cash, and gives the central bank more room to cut interest rates in a downturn without hitting zero immediately. The key is stable and predictable. It allows businesses and households to plan, invest with confidence, and avoid the uncertainty of wild price swings. So their job isn't just keeping prices from rising too fast, but understanding what's driving those changes. Is it strong demand, supply chain problems, energy shocks, or just people's expectations of future inflation? And then managing those drivers. Now, thinking about how they manage this, especially in a world with high government debt like we discussed, it's really crucial to understand the difference between two scenarios: monetary dominance versus fiscal dominance.
Okay, two kinds of dominance. What's the difference?
Let's imagine the central bank is the monetary chef. They're in charge of the heat in the economy's kitchen, adjusting interest rates. Under monetary dominance, this chef is independent. They have the power and the will to raise rates to cool down inflation, even if it makes borrowing more expensive for the government, who we can call the fiscal chef.
So the monetary chef calls the shots on inflation.
Right. Their priority is clearly price stability, and they act without undue pressure from the government's spending needs. Fiscal dominance. That's the tricky one. This happens when the government's financial situation, maybe really high debt, huge deficits, maybe political inability to raise taxes, becomes so overwhelming that the central bank feels pressured, maybe even forced, to keep interest rates artificially low. or even worse, to effectively print money to help the government fund its spending,
Even if the central bank knows it will cause inflation.
even if they know it might lead to higher inflation. In this scenario, the central bank's hand is essentially forced by the government's urgent fiscal needs. Its independence is compromised. Fiscal concerns start dictating monetary policy, not the other way around.
And that often leads to.
Often leads to inflationary consequences down the line.
That sounds like a recipe for trouble if the two chefs aren't working together, or worse, if one is just constantly giving in to the other. Does the public's perception of this dynamic actually matter? Do our beliefs about government debt somehow affect future prices?
Oh, absolutely. It matters profoundly. Research from the Boston Fed shows that how people perceive these dynamics significantly influences their inflation expectations.
And expectations can become self-fulfilling.
Exactly. If individuals and businesses expect higher inflation, they'll demand higher wages, they'll raise their prices preemptively, and that just perpetuates the cycle. The research found some households explicitly link higher government debt to GDP ratios with higher future inflation, especially if they believe the government's resources are stretched thin and that the central bank will eventually have to step in and, monetize that debt.
So they anticipate fiscal dominance.
Pretty much. Their view is consistent with that concept. For instance, one study found that simply informing people about Italy's significant government debt, which is huge, currently around 2.7 trillion, about 156% of its GDP, and projected to grow even more.
Just telling people that fact.
Just telling them that fact led many people to immediately revise their inflation expectations upward. It's not just academic. It powerfully shows how deeply intertwined public finances and individual perceptions of future inflation really are. If people think the government's debt is unsustainable and will force the central public hand, they'll adjust their behavior today. They'll expect and demand higher prices.
Let's revisit our kitchen analogy for this power struggle. You've got the monetary policy chef, the central bank, trying to manage the stove's heat interest rates to cook the economy just right, aiming for that stable temperature. Meanwhile, the fiscal policy chef, the government, keeps deciding the ingredients, spending, taxes. They keep piling in more and more expensive items, running up this huge tab.
Right.
If that tab gets so big that the monetary chef feels obligated to help pay for it, maybe by keeping the heat low even when things are starting to bubble over.
Or turning up the heat to cook everything faster.
Right. Turning up the heat, allowing more inflation just to cook all those expensive ingredients, even if it risks burning the whole meal. In that scenario, who's really controlling the spice level, the inflation, in the economy, it creates a very tricky, potentially damaging dynamic.
An extremely tricky dynamic. Now, let's look at a very real-world example of a central bank right in the thick of this fight, Turkey. The Central Bank of the Republic of Turkey, the CBRT, has been aggressively working to regain price stability after a period of really high inflation.
They've had very high inflation there, haven't they?
Extremely high. They've laid out clear targets now. They're forecasting year-end inflation at 24% for 2025. That's still high, but down from previous levels. And their aim is to bring it down further to 12% in 2026 and eventually hit their medium-term target of 5% by 2027.
That's quite a path down. Shows the scale of the challenge.
It really does. It illustrates the immense challenge and the sustained commitment needed to tackle deeply embedded inflation. And the drivers of inflation in Turkey are a complex mix, both domestic and global factors, many mirroring challenges seen elsewhere. Domestically, they've seen inflation fueled by significant wage adjustments, big pay rises feeding into costs.
Okay.
There's also time-dependent price setting, which we'll get into, where firms only adjust prices periodically, and backward indexation.
Backward indexation, what's that?
It means prices for many things, especially noticeable in rents, are contractually tied to past inflation figures. So even if current inflation starts falling, these prices keep rising based on previous high inflation, creating inertia.
Ah, so it keeps inflation sticky.
Very sticky. Globally, of course, commodity price swings, oil, gas, food have played a big role. And even lump sum tax increases by the government added to inflationary pressures, showing that fiscal monetary interaction again. So in response, the CBRT adopted a very tight monetary policy. They aggressively raised their main policy interest rate to a really eye-watering 50% in March 2024.
50%? That makes borrowing incredibly expensive.
Hugely expensive. The aim was to significantly cool down demand and investment. Now, they did make a small cut later, down to 47.5% in December 2024, as some very early signs of disinflation started to appear. But the overall stance remained firmly focused on price stability.
So mostly using the interest rate tool.
Primarily, but not only. They
Mhm.
also deployed what are called macroprudential tools.
Macroprudential.
These are targeted regulatory measures. Think beyond just interest rates. They adjusted reserve requirements for banks, how much capital banks had to hold. They used measures to encourage people to hold Turkish lira deposits instead of foreign currency. They managed foreign currency loan growth to reduce risks.
So trying to influence the financial system more broadly.
Exactly. The goal was multifaceted. Enhance how their interest rate decisions actually affect the economy, what they call monetary transmission, and stabilize the currency, all contributing to the inflation fight.
This is really interesting. The CBRT identifies two distinct ways firms actually set prices. Understanding this seems crucial for knowing how inflation behaves. Can you break down state-dependent versus time-dependent pricing for us? It sounds like it gets into the nitty-gritty of business decisions.
It absolutely does, and it's crucial for central bankers trying to predict and manage inflation. Let's start with state-dependent pricing. Imagine a flexible market stall owner.
Okay.
Firms using this model change their prices only when specific economic conditions, maybe their input costs, raw material prices, demand levels cross a certain threshold. The state of the economy triggers a price change.
So they react quickly to big changes.
Relatively quickly and dynamically, yes.
Yeah.
If the cost of flour or fuel suddenly spikes, they'll adjust their bread prices or delivery fees pretty soon because the economic state demands it. Time-dependent pricing, on the other hand, think of a restaurant with pre-printed menus that they only update once a year.
Got it. Set intervals.
Exactly. Firms adjust prices at fixed, predetermined intervals annually, semi-annually, quarterly, regardless of immediate economic shifts. Even if their costs have crept up significantly, they might wait until the scheduled price review.
Which makes inflation more persistent.
It can, yes, more sticky. Because some prices aren't reacting dynamically to current conditions, even after the initial shocks have passed. Think about annual rent adjustments or magazine subscription prices. The CBRT estimates that in Turkey, for their B index, that's a core inflation measure, filtering out volatile items like food and energy.
Giving a clearer underlying picture.
Right. For that index, an estimated 79.9% of products are subject to state-dependent pricing as of 2025.
So most prices do react quickly to conditions there.
A large majority, according to this estimate. It suggests that if costs or demand change significantly, prices in a big chunk of the Turkish economy will likely respond fairly rapidly, which can be both good and bad for policymakers. Inflation might rise fast, but maybe can fall fast too if conditions change. Okay, knowledge gap time again. This raises an important question, especially thinking about places like Turkey. In economies where a significant portion of household savings are traditionally held in non-financial assets, physical gold, real estate, housing, how do these deep-seated asset preferences influence the effectiveness of traditional monetary policy tools, like just adjusting interest rates?
If people are putting money in gold, not banks, do rate hikes work as well?
Exactly. Does it transmit as effectively? And if these traditional tools face limitations because of these unique household behaviors, what innovative, maybe non-traditional tools might central banks need to consider to achieve their goals of price stability and financial system resilience? Something beyond just rate hikes.
Fascinating. From the micro level of how a shop sets its prices to the macro level of central bank strategy fighting inflation, these forces really shape our economic reality. Now, let's try to connect these threads. Debt, the dollar, inflation, to the broader economic health and the future risks we face globally. Let's bring it all together.
Economic intersections, growth, labor, and global dynamics.
Okay, shifting back to the U.S. for a moment. The CBO's long-term outlook, as we touched on, it paints a picture of significantly slower economic growth ahead. They project real GDP growth averaging only 1.6% per year over the next 3 decades.
1.6%. That sounds quite low compared to history.
It is notably slower than historical averages. It really indicates a potential deceleration in the pace of economic expansion, the rate at which living standards improve. And a key, increasingly pressing reason for this projected slowdown is demographics. We mentioned it briefly before. The U.S. population is projected to age substantially. And without robust immigration, it could actually start to shrink by 2033.
Rank the total population.
Potentially, yes, according to CBO projections excluding immigration. This demographic shift inevitably leads to much slower labor force growth. They project an average of only 4.3% per year over the next 30 years. That's less than half the historical average of 0.8%.
Fewer workers.
Fewer workers means fewer people actively contributing to production, innovation, tax revenues. Now, combine that with increased federal borrowing, potentially reducing private investment, that crowding out effect.
Right.
It means workers become less productive overall, less capital per worker.
Mhm.
That further dampens the nation's economic output and its potential for future prosperity.
So it's a compounding problem.
Yeah.
Fewer workers, and each worker potentially less productive because of less investment.
That's the CBO's concern, yes.
And policy choices in Congress, they can definitely amplify or maybe mitigate these trends, can't they? We hear discussions about things like a current policy baseline, I think floated by Republican leadership, basically assuming expiring tax cuts get extended without paying for them.
Right, that's a common budgeting approach.
It highlights how political accounting tactics can really influence those deficit projections, right?
Yeah.
Making the fiscal picture look maybe less dire by simply assuming certain policies continue without acknowledging their full cost.
It certainly impacts the baseline numbers used in debates.
And that, of course, sparks these intense debates over Senate rules, budget responsibility. It just shows that tight, often contentious link between today's political decisions and the long-term economic health we're talking about.
A constant tension, absolutely. Now, let's swing back to Turkey for a moment. Their economy, despite the high inflation, grew by a pretty solid 3.2% in 2024. That shows some resilience.
Where did that growth come from?
Primarily driven by the services sector, which was quite robust,
Yeah.
and also significant expansion in construction, partly fueled by the huge earthquake recovery efforts ongoing there.
Reconstruction spending.
Exactly. And the labor market also saw positive signs increases in both employment and the labor force participation rate, so a growing, active workforce. However, as we discussed, Turkish households have that unique financial profile, a relatively low ratio of financial assets to GDP. They don't hold as much in stocks, bonds, traditional savings compared to the size of the economy.
They prefer tangible things.
Right. There's that deep-seated traditional preference for non-financial assets, physical gold, and real estate, especially housing. These assets have historically been seen as reliable stores of value, especially during high inflation or currency depreciation. They've often significantly outperformed financial instruments.
So it's not just cultural, it's been a rational response to their economic history.
Very likely, a rational response to historical volatility, maybe a perceived lack of trust in financial institutions during really turbulent times.
And this preference for gold and real estate, it really highlights a different approach to preserving wealth compared to many Western economies where financial assets dominate. It's a cultural, historical, economic factor that must significantly impact their domestic financial dynamics and even how effective central bank policies are, like you said before.
It absolutely does. It changes how monetary policy transmits through the economy. And it's crystal clear that these national stories, U.S. debt, Turkey's inflation battle, household preferences, they are not happening in isolation. They are deeply intertwined within the global economy. It's a complex web.
Everything affects everything else.
Pretty much. Global fiscal policy uncertainty, say debates about debt levels everywhere, can ripple through international bond markets, affecting borrowing costs for all nations. The potential for increased trade protectionism tariffs, barriers poses risks to global supply chains, economic efficiency.
Geopolitics, too.
Definitely.
Yeah.
Ongoing geopolitical tensions, U.S. sanctions on Russia impacting oil prices globally, instability in the Middle East affecting shipping routes, they continue to fuel volatility in commodity markets. They introduce persistent upside risks to inflation forecasts everywhere. Think about the global energy system. It remains profoundly interconnected, consuming over 100 million barrels of oil every single day. Demand keeps expanding, especially from rapidly growing economies in Asia.
Wow, 100 million barrels a day.
It's immense. And this constant, huge global demand for critical resources deeply influences commodity prices. That, in turn, impacts national economies like the U.S. and Turkey, almost regardless of their specific domestic policies. A shock in one part of the world, an oil price spike, quickly sends ripples across the entire system.
Okay, so what does this all mean for us? For the individual listener trying to make sense of these huge economic forces swirling around. We've seen the path of a nation's debt, the stability and role of the dollar, the fight against inflation. They're not separate issues.
Not at all.
They're all part of one massive, interconnected system, constantly influencing each other in ways both obvious and subtle. Understanding these intricate, dynamic relationships, it helps us move beyond just the scary headlines, right?
Yeah, hopefully. To a much deeper, more nuanced appreciation of the economic currents shaping our world.
Seeing the whole ecosystem, not just the individual trees.
Exactly. Seeing the connections.
Yeah.
Outro.
So we've taken quite a deep dive today into the complex world of national finances, the mighty dollar's global reign, and that ever-present challenge of inflation. We tried using the Feynman technique to simplify these vital interconnected concepts.
From the CBO's long-term projections for the U.S. showing that looming debt challenge,
Right.
to the CBRT's aggressive battle against high inflation in Turkey, we've seen how these forces aren't just linked. They're constantly influencing one another in this dynamic global dance. And recognizing these connections hopefully empowers you, helps you better understand the economic news, maybe anticipate shifts in global or local markets, and just think more critically about the policies that shape your financial world, your daily life.
It's about building that mental framework, isn't it?
Yeah.
For understanding the powerful, often invisible hand of economics.
Precisely.
So here's a final thought to mull over as you go about your day. If the global financial system is truly this dynamic, interconnected web, always evolving, what transformative role might emerging economies like Turkey, with its unique household financial behaviors rooted in history and its active innovations in things like digital payment systems, what role might they play in shaping a potentially more multipolar financial future? One that moves beyond the kind of single currency dominance we've known for decades.
That's a great question to ponder. And for your own continued deep dive into these fascinating topics, maybe consider these questions. First, given those ongoing pressures we discussed for lower taxes in the U.S., but also for increased spending on big programs like Medicare and Social Security, what truly innovative, politically viable revenue streams or spending efficiency reforms could fundamentally alter that long-term debt trajectory without triggering a crisis or unfairly burdening future generations?
The holy grail of fiscal policy.
Pretty much. And second, considering how central banks like Turkey's CBRT are actively implementing new digital payment systems, like their fast instant payment system, and also working on financial literacy, how might these domestic technological advancements ultimately influence a country's resilience against global economic shocks, or its ability to manage inflation more effectively, especially when traditional tools face unique challenges, like those household preferences we talked about?
How technology might change the game for central banking. Lots to think about. Thank you for joining us on this deep dive into the powerful forces shaping our economic world.
Thanks for listening.
Until next time, keep asking questions, keep making connections, and keep building your knowledge.